Hey guys, welcome back. Today we are going to solve a problem which is from CFR paper Ind As 103 business combination. So previous question from December 25. Easy question only. They haven't asked even for a consolidated balance sheet, but this question is asked for 14 marks. We can easily score if this kind of question has been asked in exams in future days. So let's understand what's the business combination is. Business combination is nothing but uh, there is a business there can be two businesses, A and B. A might acquire this business either by way of paying cash to the shareholders or to the company, or issuing the A's shares to the B's owners by equity acquisition, or by issuing debenture, anything kind of any way of consideration will be given to the owners of the B, and it will the assets and liabilities of B will be transferred to, or like it's like it will be merged with the A. So in this process, we'll be calculating the purchase consideration. What's the consideration with that A is being to B? First one, purchase consideration. Next thing, we have to find whether there is a goodwill or gain on bargain purchase. Anything beyond the net assets or below the net assets has been paid. Okay, net assets is the fair value to pay for the company. If you're overpaying that, that will be goodwill. If you're lesser paying from that value, then it will be GBP. Okay, so once you find the GBP, and then yeah, I missed another one thing. Uh, with the purchase consideration, next point itself is the net identifiable assets we have to calculate. Okay, and then we can calculate the goodwill. Once goodwill calculated, we have to post the journal entry and close this sum. That's it. This is the simple overview of this problem. Um, Okay, on 1st April, Alpha Limited acquired 100% of equity shares of Beta Limited. Okay, the consideration was discharged by issue of equity shares of Alpha Limited. The summarized balance sheet of companies as at 31st March 2025 were as follows. Okay, the summarized balance sheet, they have given the summarized balance sheet, and they also have given the additional information most important for to solve this problem. Purchase consideration they have given, what they have said. Purchase consideration. Okay, equity share capital, A is issuing to B, which is Alpha is issuing to B, which is 80 lakhs into 10, 800 lakh, plus on premium, securities premium, which is 80 lakh into 2, 160 lakh. And then Alpha Limited also agreed to pay contingent consideration of 50 lakh payable after 2 years. The fair value of contingent consideration at acquisition date is 40 lakhs. So contingent consideration, we should not take the future value. We have to take the acquisition date estimation value. Okay, contingent consideration is like if the company is the acquired company of B will be, if acquired company B is performing well in future days, the Alpha Limited might promise the company to pay in future. So if the company we are purchasing is performing well, na the will be giving more amount. That's amount is contingent consideration. It can be paid. The company is performing well. It won't be also paid, because if the company is not performing well, they don't pay to the Beta Limited, right? So contingent liabilities will not, sorry, contingent consideration. On the future date, it was 40 lakhs. Total this will be getting 1000 lakhs as a purchase consideration. That's it. Okay, and then second part is net identifiable. Okay, for calculate net assets, what are the things we need? We need purchase, we need assets, we need liabilities. All will be at fair value, most cases. Okay, under liabilities we have trade payables, which is 500 lakhs, and then PPE, which is 950, and then these are the fair values we have to take, okay. And the inventories 280, and then trade receivables, which will be 190 minus 10, which is 180, and then cash, which is 100, okay. Cash is given in the question itself, 100, okay. Total this, and 950 plus 280 plus 180 plus 100, which is 1510, minus 500, which is rupees 1010, is the net identifiable assets. So we finish the second question, which is net assets of beta at fair value. The third question is goodwill or gain. As I already said, they are paying the purchase consideration of rupees 1000, but the acquired the assets they are going to acquire is 1010. So they are paying less. So they have bargained well. So that's a gain and bargain purchase, right? So goodwill or bargain, GBP. Purchase consideration, which is 1000, minus net identifiable assets, which is 1010. Then he'll be getting the gain on bargain purchase. Yes, okay. So we found the gain on bargain purchase also. Now what they've asked is, they have asked us to post the journal entry. Okay, let's post the journal entry. What are all the assets in the books of Alpha Limited? Okay, what I have already said, if Alpha Limited is if Alpha Limited is acquiring the assets of Beta Limited, what the assets of Beta Limited has to become? It will come on the debit side, PPE account, which is 109.50, and then inventories, which is 280, and then trade receivables, which is 180, cash 100. Okay, before we posting this entry, we have to post one common entry, just like investment in Beta Limited, right? They are this is a common entry, common or now separate financial statement entry, okay, SFS entry. 2, liquidator of Beta. Oh, this is just nothing but the purchase consideration they are paying for the liquidation of Beta. Okay, so 1000 is the consideration. Okay, now this is the first entry, this is the second entry. So PPE, inventory, trade receivables, cash recorded at the debit side of Alpha Limited, and then 2 liabilities will be there, which is trade payables, which is 500. It was given in the question itself. Trade payables 500. 2 investment in subsidiary, which is nothing but the purchase consideration, see, 1000, and then 2 gain on bargain purchase, 10. So 950 plus 280 plus 180 plus 100, which is 1510. Okay, so 1510. Okay, the journal is tallied. Now we have to post the entry. This is the entry we have to post when the company. The next entry is, we have to read the question. Company balances. See, there were intercompany balances between the Alpha Limited and Beta Limited. When there is a intercompany balances, no, we have to close those balances. That should not be reflected in books a year after, because that both companies has merged. No, so what we have to do is, Alpha limited is having trade receivables. So what we have to do, we have to credit the trade receivables, we have to debit the trade payables. Okay, how much it is? 20 lakhs. And then expenses of share issues amounted to 12 lakhs. Okay, share issue expenses account debit to bank 12 lakhs. The share issue expense can be utilized from share issue expenses can be utilized from the account of securities premium, because security premium we collected can be used for used to pay share related expenses, right? So we are setting off from that, and then we are closing the question. That is it. Very simple problem, easy 14 marks we can collect. Okay, meet with some other new problem tomorrow. Thank you.